Welcome to the Lone Star Capital Podcast. I'm Rob Beardsley, founder and principal.
And I'm Craig McGrouther, Director of Business Development.
On this show, we talk about real estate investing, business,
And so much more.
I almost feel out of practice because it's been so much time. Has it been a month, roughly?
Yeah, about.
It's like a little sabbatical here, but we're back. I know everyone missed us. We missed you, but we are live today. Episode 100. Big deal.
Wow, big deal. Can you double check your mic? It's been so
it?
long. I don't know what your mic is supposed to sound like anymore.
Really? Well, you are accurate because it's not correct. So we're going to have to restart this.
Episode 100 of the podcast after about a month-long delay. And a ton has happened between now and then. I know, Rob, you love talking about your personal life, but we got officially a married man on the show.
Yes, that is correct.
I gave a public speech, which I have fear of doing, as I was the best man, but I think it went okay. I didn't embarrass anyone as far as I'm concerned, nor myself, so that's pretty crucial there. I think that's all that covers right there in that one. But we were back after about a month away. We were both in Europe, enjoying our lives, catching up on that. And episode 100 here on the pod. Pretty crazy if you think about it.
Yeah, I'm excited.
Yeah. What's new with you? Let the people know.
Well, I was not in Europe enjoying myself. I was in Europe fulfilling an obligation called a honeymoon. But now I'm back.
I'm sure Brigitta's really going to appreciate that one.
Yeah, she knows how I feel about vacations.
At least we're all transparent about it. Perhaps when the market's roaring up, the vacation will feel a little sweeter, huh?
Yeah, I mean, there's times of relaxing, there's times of battle, and right now is battle time.
Yeah. Well, I'm happy that our fearless leader is not missing a beat and is ready to go, but we're here to deliver a great show as always. But before I get into it, we've got our Lone Star Capital Summit, which is almost full on space, but there is a little bit of room left for those who are wanting to attend, I believe. It's an application process. Reach out there. It's on our website, lscre.com, and go to the checkout page or the discovery page to fill out the app there if you're potentially a qualified person there. Very exciting there. We've also got some exciting news in the deal front, but we can't share too much about that. But if you are looking to place some capital coming up, we may have a fit for you. So reach out to me. The email's Craig, C-R-A-I-G, at lscre.com. Let's get right into the show. First things first, we would be burying an impressive and the most important lead if we didn't go into an incredible company-wide win, an investor win on a special deal there, which was Cortland, or formerly known as Cortland Copperleaf, now known as Preserva Copperleaf. We just conducted a 45% cash out refinance in that deal after 1 year of ownership, with the remaining equity in that deal going to be distributing somewhere between 8% now and potentially up to 10%, assuming we're getting the growth coming up here. But exciting stuff. Rob, I know you wanted to deep dive into that, so I'll let you do it.
Yeah, so that's a cash out refi like this is, number one, never in our business plan explicitly, but when the opportunity arises, we of course have to take advantage. And in this situation, there was a few unique set of circumstances that allowed us to pull off such a great outcome for investors. First and foremost, we acquired Preserva Copperleaf in May of 2024, but we actually secured the deal sometime around November, December of 2023, which I pinpoint as somewhat of the bottom for Class A-ish, B-plus multifamily, because now, just a year or so later, the market, particular market has rebounded substantially because institutional capital has come back into the market, and institutional capital in the multifamily market is focused all into institutional quality assets, right? So that's excluding the C-class assets. It's excluding a lot of 80s vintage assets, especially if they're not in prime locations. And most 80s vintage assets and older are not in prime locations. So you've got this cluster of equity that all wants to be in the select few deals, and that's really caused prices for those assets to rebound. But Preserve at that time in at the end of 2023, that was a time where institutional money was on the sidelines, and so it was a much easier time to win a deal and also buy a deal at a discount. So we feel like the valuations at that time are very attractive, and our basis on Preserve is very attractive. So that's number one. Number two is because of our experience and relationship with the local housing authority, we knew that with the right timing and patience, we'd be able to actually execute a property tax exemption on the property. So even though we originally acquired the property as a market rate investment, we pivoted into an affordable housing strategy, which we knew would be more accretive and actually be a better highest and best use for the investment. And upon converting the property into affordable housing, getting the tax exemption in place, and of course, riding the wave of this rebound of capital flow into the market, we've seen cap rates compress. So we acquired the property for around 34 million, and our appraisal for the refi was over 53 million. So in just a year, basically,
That's an absurd. And also, I just want to remind everyone, 33. You said 54.
53.7.
And we only put initially in about 8 million of equity. So the
12.
equity 12, okay. The equity growth, I was thinking about Regency growth. The equity growth on that deal is absolutely absurd. The property almost doubled in value, but the equity in there is more than doubled to this point based off the refi.
Yeah, the power of leverage. And those are the key details that are important to mention, because at least I know sophisticated investors, their minds are instantly going to think when they hear a 45% cash out refi in a year's time or so. An experienced investor is going to think a couple things. They're going to think, well, one, maybe they bought it originally at low leverage, and then now they're slapping a ton of leverage on the deal, and that's how they're getting this big cash out in a short period of time. Or I mean, whether you started low or and went higher, or either way, basically you're putting on more leverage than appropriate in order to really get to that 45% cash out. Where if an investor put in 100,000, they're getting back 45,000 through this capital event, not tax free, of course. So that's a distinction, because when we talk about the appraised value, we talk about the fact that we put a 7-year fixed rate, full term IO, low leverage, 65% LTV Freddie Mac loan as the refi to be able to get a 45% cash out refi via a low leverage takeout. That's really the magic. Our goal in investing is not to do the biggest cash out refi possible. We're not trying to turn equity as quickly as possible. We're long-term investors. We want to be working with investors who think and feel the same. And so it's really, our mission is to keep our equity at work. And when you refi dollars out of a deal, you're taking those dollars out of their job. So we're not necessarily we're not trying to just refi out dollars for the sake of it, right? We did it on a low leverage execution, and it just so happened that there was cash out because of the factors I mentioned, the low going in basis and the execution of the tax exemption. So that's what really makes this story remarkable.
Absolutely. And I think the important thing to think about here too is we're not doing this to be in a situation because it is even conservative in the cash out refinance. We probably could have pulled up more proceeds, but we want there to be a healthy amount of reserves and also there to be really good cash on cash returns for investors who are currently still in the deal. So obviously hitting that kind of DSCR obligation is very important to us because you don't want to pull out a bunch of money and then all of a sudden have the cash flow kind of dry up. Let's say if rents maybe stay neutral or go down, your expense ratio gets hurt. We're so clear on this one and so confident and are in such a great spot that we're just very excited about the fact that cash flow is there. And then I think something to think about too is some people, when they get these or have questions about kind of the fundamentals as it logistically works. So for those who may or may not have ever been in a cash out refinance in a syndication before, let's say you invested, I love the number, is $100,000 to keep math simple. You got $45,000 back, which is obviously a non-taxable event, which is one of the beauties and powers of real estate and the tax advantage returns. When people are talking about that, oftentimes this is kind of what they're referring to situations like this. But what's really cool about this, or I guess just how it works, is if you invested that 100,000, you got $45,000 back that now you can invest, spend, do whatever you like with. Well, the remaining equity in the deal is now $55,000. So now we're projecting about an 8% cash on cash for moving forward. Well, the 8% cash on cash moving forward is not based upon the $100,000 number. It's now based upon the remaining equity within the deal. So now you're getting about an 8% return on that $55,000 there. But obviously, as we know, time value money is very crucial. But you're also not getting diluted in this situation either. So your cash flow does technically go down, but now you've got your same interest in the deal. You've got the cash flow based on the remaining principal, and the time value money equation really gets great there. But this is overall a really large win in investor. I did say a lot there though, Rob. So can you maybe comment and go into maybe a couple more layers there, if you will, if you think it's appropriate in relation to what was just mentioned?
Well, like you mentioned a good point where the distributions now go down on a dollar basis, even if the percentage stays the same
Or even increases.
or even increases. You might, because we will most certainly look to increase these distributions 8, 9, 10%, hopefully even higher. But like you said, that percentage is based on a lower equity amount because it's based on the residual equity post cash out. So some investors might bemoan this and say, well, I don't want the cash out. I really was enjoying, I'd like to enjoy 8% cash on cash on my 100,000. I don't want to get 8% cash on cash or even 10% on 55. And I agree with them, right? Like we just said earlier, the name of the game is to have our dollars be at work rather than have them be taken out of their job. So the downside, if you will, I mean, there really is no downside of the refi because we're actually bringing down our interest costs, right? We refied into low leverage, lower interest rate than before,
And longer debt.
longer term, full term interest only. So it's a reduction of cost, reduction of risk, increasing return. So there's really no downside. But someone might say, well, it's a bummer now because now I just had 100,000 working for me, but now I have 45,000 less working for me. And that's where the next step of the process comes in, where as an investor, you need to think, okay, this money came back to me. I need to get it back to work. And that's where you can really create compounding value because you've had a great result on this deal. You get $45,000 back or 45% back, and then you put that money to work on a new deal. And maybe that new deal, we can't bank on every deal being a home run with amazing performance and upside outcomes and things like that. But hopefully that 45,000 can be placed into a new investment that can be on its way to be similarly producing 5%, 6%, 8% cash flow. And of course, appreciation, which you need the two, right? We're not in it just for the cash flow. We're not in it just for the appreciation. We're really solving for the best risk-adjusted total returns that we can. And the way to do that is by keeping your dollars in the game rather than when you get cash out proceeds, you just, say, oh, well, it's just going to sit in cash now. And that's going to kind of erode your total returns.
Appreciation and cash flow, the big, beautiful blend. That's what I like to call that. But really good stuff there. And I think another thing that I want to highlight and key on here, this is something that just long-term philosophically, we find this to be the wisest choice as we go through our evolution as a firm, as a sponsor, as we kind of take note from what's happening in this point of the cycle, which we've been very fortunate to be very stable in a very unstable time. But having said that, the debt term that we got on this is 7 years, interest only, and relatively lower leverage. And I think as we go forward, that's the structure that we want to be doing. We find this to be a smart thing to do because once that interest only period does burn off, your cash flow can really hurt. So this really does help investors get, pretty consistent and healthy cash flow during the duration. Obviously, since it would be not amortizing, you're not building equity in these properties per se, but oftentimes these investments are really about basis buying and then, creating the value and then selling, the enhanced value to the next person there. Really, you're not, taking out a 35-year, long HUD loan here and paying the sucker down over time. So the nature of the deals that we're doing, having enhanced cash flow, having full term IO is really accretive for our position. Moreover, it's hard to get in trouble in deals when you've got lower leverage and interest only. Cash flow is the health of really every business, and these deals and these investments shouldn't be any different there. So I really do want to showcase the importance of that there. And then also, taking lower leverage, the people that are struggling right now are out of money, which means, maybe there's bad cash flow, and they're out of time. So solving for those two things there, and then also leverage. I guess so solving for those three things right there will really enhance the security and safety of our investments and investments. And I just think holistically, as we invest in real estate, we're wanting to do those three things, making sure that those things are hit there. And when you do that, you're just going to mitigate your downside substantially. Living on leverage, living and dying by that sword is just, a gamble and a risk I don't really feel too inclined to take.
It's stressful. Who cares how much money you make if you're stressed out?
I love
But
that.
So I don't really know many people who prefer amortizing debt versus interest only. The
It's
vast
probably
majority,
more of a, hey, I'm owning this forever and I'm maybe in the prime of my career. I don't really need the cash flow. I just want to pay the sucker down, perhaps. The
yeah.
different
But
seasons.
the return that you receive on your amortization is the interest rate of the loan. So why do you want that? If you like the return so much of your debt interest rate, then why borrow it in the first place? Why not just be the lender in the first place? I mean, I'm being a little bit, uh, you know,
Silly, but yeah.
Anyway, there's obviously a time and place for it, but I think by and large, the vast majority of people prefer interest only debt because that way they can maximize their cash flow. But nothing is free. And so when you're looking at interest only debt versus amortizing debt, the big downside of interest only debt is a lender will not give you the same amount of loan proceeds as they would be willing to if they knew the loan was going to amortize. And so that actually is an amazing trade-off for us because we don't give up anything
It's
because we
great.
want the lower leverage anyway.
Yeah. It's like, you don't have to sell me on it. Yeah.
So it's a perfect program. It's a perfect strategy that aligns well with the types of investments that we make, which are more stable long term. We're not trying to flip something. We're not trying to just quickly value add something and make it worth more overnight and then sell it. We want to be in the game long term because the longer you're in the game or invested in a particular investment, you can smooth out the outcome, right? The longer the term, the lower the risk because you can ride out the storms versus getting caught in a bad time, a bad market, or a bad event happening in particular in the deal, or a loan maturity.
Yeah. And with 7-year terms, with interest only on that, with lower leverage, it will obviously affect something, right? There's a give and a take. Perhaps these deals and these structures might have a little bit lower of a projected return. And I'm really going to harp on this word, projected return. You might have a lower projected return, but is that a projection? I think so often people only look at the home run outcome, only look at the upside, while really not factoring the downside. And I think this really does solve for that while still having, some pretty exceptional projections. This gives you solid projections, but also really does stymie the downside. And I think that's really one thing that as we move forward, we're looking for capital partners and investors who appreciate that disposition, who are looking for that outcome there, that are still getting probably better than market beta returns, a great cash flow. And I think cash flow is also something that you look at the holding period, trying to get somewhere between a 6 to a 7% cash on cash return is quite possible when you do it like that. So it's very exciting to think about. It's very exciting to see the evolution. As an investor in our deals, I love that. And really, quite frankly, when you're getting somewhere between a 6 to an 8% return, you really have to sit and think and scratch your head about, well, from a cash on cash perspective, why the heck would I ever invest in private credit or debt if I'm a high earner, right? If I'm a high income earner, if I'm in a top bracket, your tax on that interest income is going to be really bad. Maybe you get some liquidity, which is maybe potentially a benefit. But when you factor out, bonus depreciation, which will be a segment later on, which is coming back in 100% form, it really does make the multifamily investment, if you are getting to that, call it 5.5 to 8% cash on cash return, to be quite superior to that hard money and debt investment play. So yeah, moving and switching gears, We're very excited about that. And as I said, if you're looking to perhaps do any deals in 2025 throughout the latter of the year, if you're looking to invest, raise capital, anything under the sun there, please reach out to me and I can share the latest and greatest of what we're cooking on and how a partnership with Lone Star Capital may help and work with you. Moving on to the next subject that we want to talk about, are you done with the refi section or anything else to add? I should
No.
ask. Cool. Moving on to the next section, which is budgets. So budgets is very interesting. I think being nimble and being wise with, I think we all get into business plans. And as Mike Tyson said, everyone's got a plan until they get punched in the mouth. Well, you never know what the market's going to throw at you. And, budgeting and things of that nature, you got to kind of move on a fly, be nimble, be willing to be creative to get the best outcome possible. But I know you really wanted to speak on this subject for some time. Where you're going to go with it, I have no idea, as it's not my forte, but I look forward to hearing about it.
Yeah, well, we can segue to this budget topic actually through the Preserve refi, because prior to refinancing Preserve, we needed to actually do a budget for Preserve to understand the future of the property, as well as how much debt would be prudent to take on as well. So, and not to, point fingers at anyone, but because, this was us not too long ago, but most people in our business, basically the way they approach lenders and debt is they're going to submit the financials and the information of the property to the lender, and however much debt the lender is willing to give, that's how much they're going to take. And then they go and kind of figure out the rest later. And so the strategy, or the more prudent way to go about it actually is on our end to put a budget together to evaluate the cash flow potential of the deal, and then also underwrite the investment, or the loan rather, the interest rate, and really look at and see, okay, what is going to be the true DSCR? What's going to be, how much cash flow are we going to be able to generate here? How accretive is the debt? And then we kind of take that and we give that to the lender and we say, hey, this is the loan that we're looking for. So let's get the best terms based on this target loan proceeds, rather than saying, hey, give us as much loan proceeds as you can. So the budget process is critical in a situation like this with the refi, where we can evaluate, okay, moving forward, the property is going to perform at this level. The refi debt terms are going to look like this. Therefore, we're going to be able to cash out this much. Therefore, we're going to be able to cash flow this much. And so you can't do that, all that without budgets. So that's a little intro to just budgeting, kind of, pretty straightforward, but it's something that you just need to do. Now, to get into some of the more nuanced kind of topics on budgets, one thing I want to mention is the consensus budget practice in our industry is to do calendar budgets, or meaning putting together annual budgets for 2025, January through December, 2026, January through December, right? And so basically, firms like ours will have budget season in October and November, and they'll scramble to put together budgets for all their deals, and then have the budgets finalized in December, plugged in and ready to go January, and then they're off and running into the new year. And I think that's fine. I think there's actually some benefits to that. You're kind of doing it all at the same time. It's a scramble, but I think there's also downsides. I mean, if you've got 20, 30, 50 budgets to do all at once, you're going to kind of rush through them, and that's that. So the way that we have approached budgets is actually by doing it not based on the calendar year, but actually doing it based on the anniversary of the acquisition of the project. So if we acquire a deal in February, then we're actually evaluating every year period, beginning and ending with the anniversary of the investment. So we're looking at every, February 12-month period. And this is good because it really aligns us with the investor, because an investor isn't necessarily thinking about the calendar. They're thinking about the anniversaries. They're thinking about, okay, well, I made this investment at this time, and then it's now been a year into this investment. And our underwriting is the same exact way, right? Our underwriting has year 1, year 2, year 3, and so on. And that's pro forma, that's cash flow. And so if investors are expecting us to be able to perform at a certain level such that we can increase distributions in year 2, year 3, et cetera, Well, we need to be pushing ourselves to meet those deadlines. We shouldn't have an underwriting model, close the deal, and then throw that underwriting model away and then look to our property management team for the budget and operate off that solely, right?
Yeah,
They need
it's
to be
essentially
married.
auditing and kind of fact checking and keeping yourself accountable there
It's a way
as
to
a
keep
firm.
yourself more accountable. And what's nice is if you have the budgets being done based on the anniversary, then you have budgets being done all throughout the year. So you're staying sharp with knowing your expenses, knowing your comps, knowing really every line item for the business all throughout the year. And that way it's not a scramble, right? You have them staggered and spread out, you know it's coming. And the other cool thing that connects to budgets and that's in a way that's elegant when discussing this anniversary based budget system rather than calendar based budget system are bonuses. So we pay a property budget performance bonus where our operations team and our asset management team actually are paid a bonus based on some key variance calculations between what we budgeted and how the property actually performed across 4 key categories. Number 1 being revenue, number 2 being total repairs and maintenance, number 3 being your payroll and admin costs. So quite literally payroll, administrative, contract services, things like that to run the property. And then finally, your uncontrollable expenses like utilities, insurance, and property taxes, which are more so of like an administrative item and a check on how well we budgeted and how well we were prepared and things like that. Because of course they are non-controllable expenses for the most part. And so that's not where the bulk of the bonus evaluation is. But the key components, number 1 being the most key, is revenue, of course. And then second to that, I would say, is repairs and maintenance, because there's so much variability in how you can perform from a repairs and maintenance cost perspective. You can call outside vendors for every little maintenance issue, and that's going to cost you an arm and a leg. Or if you build out the right team culture, the right on-site team capabilities to where your maintenance staff, they are good with the pool, they're good with the plumbing, they're good with turnover, they're good with roofs and all things like that, you can cut your R&M expenses close to half in maybe from like the worst to the best case. So yeah, so that is cool. The reason why that is a beneficial way to go is our operations and asset management teams are being bonused throughout the year, because anniversaries are kind of happening throughout the year, right? We might have closed a deal in February, another deal in May, another deal in November, right? So then rather than having just like one bonus at the end of the year, hey, you did a good job, or you did a good job here and a bad job there, right? It's more kind of straightforward direct feedback per deal on the anniversaries to kind of keep our minds aligned as far as, okay, hey, we're in year 1 of this deal, we're in year 2, we're in year 3, and keeping us connected to the roadmap.
I love that. And I think one thing that is super cool is that when you constantly go over budgets and you scrutinize them, you really get a good feel of the property. And when you do that on a very consistent basis, as you mentioned, you're able to see any kind of holes in the boat and make sure you can kind of correct them and take care of them as time goes on before they become bigger issues that linger into a terminal issue or something that's really going to affect cash flow or the overall experience that investors have. So the perpetual checking of this and auditing of it internally and retailoring is super important. And then also on the budget perspective, and this is just an acquisition thing at large as we pair it together, is, well, hey, last couple of years, let's say you bought a deal in 21 or 22 that was a value add, and you're seeing very quickly that, oh shoot, supply's coming online, and yeah, I raised $10,000 per unit, which was probably the going rate a couple of years ago. Well, it turns out there's going to be no return of costs. So would this be the best idea with the budget we have and the reserves that we have to renovate this? Probably not, because in many instances, you could argue that you might be lighting it on fire. So staying nimble, being smart with your budget, being smart with your reserves, all kind of comes together to create the overall holistic picture, which is creating great returns and being smart during every point of the cycle. And there also could be points where you buy a deal, you don't think you're going to value at it, or there's a point where, hey, you know what, turns out that there's a proof of concept here where we can improve a couple of units to get some premiums here, it may make sense actually to pull from the budget and to put dollars into, kind of creating a platinum finish unit here in order to, sell that to the next buyer on the exit.
Yeah, and so you said a lot of good points there, which pays to drill in on because it's some more nuanced stuff. So what's interesting is we're seeing the proof out there all the time. And I think we've talked about this on the show before. A lot of people have failed value adds on their hands, where if you analyze their rent roll, you'll see that they've renovated a portion of the units to a premium finish in hopes of getting a $150, $200
better
rent
turnout.
increase. And instead, they're getting like a $40, $50 rent increase for all that. And they're way over budget, like you said, because costs are up. So they're way over budget on the renovation, and they're getting way less of a rent increase than they thought. Furthermore, if you analyze their rent roll, and this is just, I'm not pointing out one specific deal or
This
one
is the
specific owner.
macro. Yeah,
This is just a macro thing. You're seeing this across many deals that we've analyzed that are these broken value adds. And if you analyze the rent roll, you'll see the vacancy rate is concentrated in the renovated units. So if the property has, let's say, 300 units and 100 of them are renovated, it might be the renovated units are 70% vacant because they're holding them out, trying to lease them at the higher rate. And then all the classic unrenovated units are completely full because there is demand, but it's just at that lower price because in that particular area, the renters may be tapped out. They really just want a normal, safe place to live. They're not looking for the premium finish. And that's just not where we are in the market cycle. Because frankly, if a renter in that area is seeking a renovated product, they probably have a lot to choose from because of the record-setting new supply of apartments that have been built in the country, where they can go and get the newest and nicest amenities and finishes and clubhouse and so on.
Concessions galore.
Right. And they could probably get it at a cheaper rate. So it really doesn't pay these value adds. And that's why it's frustrating for someone like me to see value add continue to be hackneyed and just overblown. Like it pains me to see.
It's very frustrating. It frustrates me as well, because as I'm having conversations regarding something that we're working on, and email me if you'd like to learn more, people ask, oh, so is this value add? What's the value add? It's like, well, some deals you don't need to value add to get a great return. And that's exactly, funny enough, going back to Preserve, comments that we got, which is, where's the value add? And it's like, it's called buying the deal really well. It's buying in the money, buying at a great basis, buying below replacement cost. And then guess what? You can sell the value add to the next person depending on where you're at in the cycle. So there's different times to pull different levers and different ways to creatively make a buck. Our track record would show that we've done re-tenanting, that we've done value add projects, and that we've done buy wells and refis out, and eventually that'll be an exit at some point. But I think it actually is a really cool way to toot our own horn here, to brag about how nimble we are and how we can see the landscape of getting returns from any kind of point of the cycle and any way to kind of create good opportunities with what we have at hand.
Yeah, the value add strategy is really overdone. I mean, people get all hot and bothered when they see the opportunity to value add a deal, but really all it means in most cases, either one, they're selling themselves on a dream, right? Because when we are evaluating these potential opportunities that we just described, where the renovated units are only commanding a $50 premium as evidenced in their partial renovated rent roll, the broker and the seller, when they're going to market that property for sale, they're not pitching it as is. They're saying, oh, well, it is.
Jobs are growing here.
And we're kind of in the middle of things. And so the broker's pitching, oh, yeah, you should complete the value add. You should renovate the other 200 apartments and you will get $200 rent increases. The seller is just doing a bad job for whatever reason, or they have to sit with those units sitting on the market a very long time just to get those few units at a proven higher rent. And so if you're the sucker going around and you just have a hammer in your hand saying, where's a value add? I need a value add deal. You're going to fall into this trap and you're going to buy this property. Or if you're an investor, you're going to invest in the sponsor who's buying the property and who's projecting, yeah, we're going to renovate the units. We're going to get $100 rent increases or $200 rent increases. And the returns are going to look great. It's like, wow, I'm going to get a great return. But it may not happen because that's just the realities of the market. So
you want to know why everyone does value add? I have a theory here because holistically, I guess from a macro perspective, people get into real estate investing. Let's exclude the primary residence, which isn't really investing, that's shelter, but whatever. You get my point. You get into real estate investing, you get a little money in your hand. What is the first thing you might do? You might go out and you might buy a home and you might flip it. And then you hear something saying, well, instead of flipping a home, why don't you flip a 10-unit project? And then you flip the 10-unit project. And then instead of doing a 10-unit project, well, I can just do this over 200 doors. And it's so easy, right? So you get ingrained in your brain to see this before and after picture. It's very easy to mentally sell yourself, but also sell, the dream. And you've seen the proof of concept. Well, I've flipped a home before, I can flip an apartment unit, right? It's just the bigger and larger scale perspective there. So that is why I think some people are trained to it, but there's more than one way to make a buck. The other thing is that I think a lot of individuals, and I can't say I'm some, senior tenured person within the multifamily business, because that would be a lie. But I'm wise enough to realize this, which is people have also made so much money off that one trick, which was value add from call it basically since GFC probably till today, that they're having to learn or having to figure out other ways to maybe see a different, or you're seeing a new picture now, which is a way to make money, which is just buying the property well. Probably from 2016 to 2019, anything you bought from a value add perspective, you probably doubled your money. And anything you bought from 21 to 22 that was value add, you probably lost all your money. So it's an unfortunate part of the timing and cycle of things.
Well, here's the real red pill. Whether it's buying a core plus investment at a great basis or buying a valued opportunity, what you just said is true. Buying right. It doesn't matter what your business plan is, whether it's land, whether it's anything, whether it's value add or not. You have to buy it right. Just because the project is a value add doesn't give you the license to pay whatever price you want for it. I don't care if you can raise the rents $100, $200, $500. You have to pay the right price for that opportunity. And so a lot of people get carried away and they see, oh, wow, I can renovate these units and get $200 rent increases. I'll pay whatever price it, because of course I'm creating value. But it all comes down to the basis. So it doesn't matter what your strategy, you always have to pay the right price.
Couldn't agree more. Do you have any more topics on the budget section?
Well, yeah, I mean, I could go on for a lot on the budgets. The budgets are so granular, and it's a great opportunity for everyone to come together and share information across acquisitions, asset management, operations, property management, because it's the on the ground feedback, it's the higher level operations, and you mentioned this before. This information feeds well over to our acquisitions side of things, to where it makes us smarter for when we're evaluating a potential opportunity and not under budgeting on admin costs, or just being properly prepared for payroll and having all the small details factored in appropriately there. So I think it's a level up in our game, because just honestly, we were not budgeting and underwriting to this level of granularity before. So it is a great upgrade. That is a needed upgrade.
I love it. Well, I think we'll probably have more budget talks, more conversations getting into the weeds, but for now, we will leave you with that. I know what you were wondering, what's in my humidor right now? So let me show you the upgrades, a couple cigars I got while I was in Europe.
Yes, Cubans are so hard to get your hands on.
Well, when you're a big G like me, it's easy. So you got right here some of these punches. I haven't tried it yet, but it looks pretty cool. So I got 5 of these. I got a couple of Monte Cristo, I think Master. Have you had a Monte Cristo Master yet?
Mm-mm.
Nor have I, but I look forward to it. These things, they probably need to sit and age for a little bit, naturally, as one does. And then I got a couple of these H Upmans, which this is the only one I've smoked so far of this. This is a really good cigar.
That's a nice cigar.
And it's so cheap. It's like the price. It's like the Cuban Oliva. It's like so cheap, but it's so good, so packed with flavor. So I'm loving it.
So speaking of cigars, we're going to have a cigar or two at our LSC Summit, right? So
Go on.
People can go to lscsummit.com to learn more information, but we're going to be enjoying some cigars here and there. And I'll be bringing cigars from my private humidor stash for the summit. So
Wow. Bajiques?
I've got stuff aging as we speak in preparation.
I love it. Well, good to be back. It's nice to be in rhythm. We got to find our footing again here, get our sea legs going, but excited for an incredible coming up of the second half of the year. And we spoke on this, just a final thought. It's been a little bit of a quirky year, as we kind of discussed about before about refinances. It's funny how you made that comment about how, oh, well, did you just come in over only to refi it later, which is kind of like skewing the system. We did not, but so many people have bought deals that we were competing on all cash, and then they're going to stabilize it, get their numbers, get their bearings, and refi out. It's not what we did here. But that said, the market is starting to bear some more options. The market is starting to present some deal flow finally. Maturity is around the corner. It is such an amazing time to get it into it. If you have not reached out to us about working with us and you're, a fund manager, you're raising capital, maybe your friend's got a 1031 exchange coming up, maybe someone that would benefit from this. If you could share this with them, if you could help us grow our platform and audience. We don't do this to get zillions of views or for vanity. We do this to really help and inform the people for the love of the game, as many would say. So for the love of the game, for the love of helping each other out, and to put someone on to the right place, send this to them. And if you think they'd be a good fit to work with us to invest, or someone weighing the options, have them give me a shout. I'll give you an honest feedback if something we have could be more compelling to the latter. But with that said, thank you so much for listening to this podcast. We'll see you next week.